Hello everyone and welcome back to another installment from our series Straight from the Horse's Mouth. This webinar is part 2 of our TCFD series, so I highly recommend you check out the previous one before watching this, which you can find on the thinkstep-anz website. This webinar acts as a continuation and focuses on how you can improve your TCFD reporting. Here's a sneak preview.
Now, in the disclosure, we don't expect companies to provide granular point-by-point demonstration of how climate risks are governed, but we expect, at least at the very beginning, an outline and a summary of the board's oversight, management's role, and the processes used to identify, assess, and manage climate-related financial risks.
It really is a multidisciplinary effort, but the accountant needs to be in the room.
Think about how to consider climate as part of your existing risk categories: credit risk, operational risk, strategic risk. And think about how climate can be a risk multiplier. I could keep going on this and I could have a whole entire section on risk management, but let's move on to some of the examples of how companies are doing this. If you go onto the TCFD Knowledge Hub, there's a specific page on scenario analysis. And on that page, there are some kind of top tips about how to get started, some of the considerations that you need to take. And there's some resources at the bottom there that might be helpful.
Companies need to consider the longer-term nature of climate change and that these will be different to normal time horizons companies may be currently implementing for financial planning, strategy setting, and risk identification. With that, let's get started.
Hello and welcome back to our webinar series, Straight from the Horse's Mouth, Insights from Experts in 30 Minutes. My name is Christin Schaller. I work as Carbon and Climate Specialist at ThinkStep, and I am your host today. During the next 30 minutes, we will give practical advice on how you can improve your climate risk reporting, sharing best practice examples. This is part 2 of our TCFD webinar series with our guest speakers from the Climate Disclosure Standards Board, short CDSB. And a huge thank you to our experts today, Zimonyi and Gemma Clements from CDSB in Berlin and London, who are staying up very late once again to be here with us today. So thank you so much and welcome. So this is our third webinar looking at the recommendations by the Task Force on Climate-Related Financial Disclosure, TCFD. And in our first webinar, we had Fiona Wild sharing her really unique insights from both of her roles, because she's member of the TCFD and VP of Climate Change at BHP. And in part 1 of our series with CDSB, Mike and Gemma shared practical tips on how to get started with TCFD. I'd really encourage you to check out these webinars recordings if you're after a refresher on what is TCFD and why does it matter, because we're not going into detail on that today. And we will share those links with you in the chat shortly. However, I will quickly share what I think are the 6 most practical tips on getting started with TCFD that we covered in these 2 webinars. So number 1, just get started. Your TCFD reporting doesn't have to be perfect from the start. It can help to start with a gap assessment to see where you're at and what you need to do next. Assemble an internal cross-functional TCFD team, because collaboration is key when it comes to TCFD. A TCFD roadmap can help you envision how to get from where you're at to fully integrating climate risks and opportunities into your organization. Then it is easier to make qualitative assessments first ahead of quantitative assessments. And finally, check in with your investors to see if your disclosure is useful to them. So before I hand over to Gemma and Mike, we'd like to understand what TCFD areas you need most support with. And we prepared a little poll. And so we give you option: is the area you need most support with related to governance, strategy, risk management, metrics and targets? So those 4 are the core areas of TCFD. Or is it related to creating your TCFD team internally? Excellent. It looks like strategy is really the area where our attendees today need most help with, followed by metrics and targets. And then governance, risk management, and internal TCFD team is kind of at the same level. So that is really interesting. So now I'd like to hand over to Michael, Policy and External Affairs Director at CDSB, and Gemma, who works as Capacity Building and Engagement Manager at CDSB. And for those who missed part one, Gemma and Mike will give a brief overview of what CDSB is and how that fits together with TCFD. And after that, we will get stuck into what I'm really excited for, which are best practice examples on how to improve your TCFD reporting. And with that, over to both of you.
Thank you very much, Christin. It's a pleasure to be with you all today, and thank you to you for the opportunity to be speaking to you today. So I'll quickly reintroduce CDSB just as a refresher. I'll be quick, I promise, and I'll swiftly hand over to Gemma to get into the meat of today's content, which I think is especially useful today. So just as a refresher, CDSB stands for the Climate Disclosure Standards Board, and we were set up back in 2007 at the World Economic Forum's annual meeting with the mission to provide decision-useful environmental information to markets via the mainstream corporate report, that is the annual reports of businesses. We're a consortium of the board member organizations that you see on the slide, and we're very grateful to be supported by a vast, I believe over 40 technical work group members that really give us the rigor to make sure that our work is useful for implementation and useful for supporting businesses in reporting to their investors. The main output of our work is the CDSB framework, which is really just a document that helps you with how to integrate environmental and especially climate change information into your annual reports. It consists of 7 principles, how to report, and 12 requirements, what to report, and they really sort of rely on your existing reporting through CDP, GRI, or others, SASB, to take that information. It's not about reinventing the wheel. And the most important point about the framework is that it is in alignment with the TCFD recommendations. In fact, it was one of the inspirations behind the TCFD recommendations. And so the requirements are actually quite, well, they are fully aligned with the TCFD recommendations. So as you are working through the TCFD recommendations and need just a little bit more guidance, a bit more detail on how to go about these things, we very much recommend you to have a look at the framework as well to help you with the implementation process. And this is a little diagram to show you where to look for each element. The last piece of element that I'd like to highlight before handing over to Gemma is the vast amount of resources that our technical team has put together from our experience, hearing from businesses about the challenges they are seeing. What does it look like? How do I do it? Etc. Etc. How do I get started? Which you covered in the last session, and Christin summarized so well. We have a wealth of guidance available on our website and also through the TCFD Knowledge Hub, which we manage on behalf of the task force to help you get started and make the best out of your reporting and get the most out of it. So very much encourage you to look at both our website, but also the TCFD Knowledge Hub, which really helps you to find all the resources that are out there to help you get started. So I'll stop there. I promised a very short refresher on CDSB and our work, and I'll hand over to Gemma to take away the meatier part of this session. Over to you, Gemma.
Thank you, Mike. Yes, so again, I'm going to dive straight in to this. And what we're going to be talking about now is how to improve your disclosure in line with the TCFD recommendations. Now, in the recent TCFD status report, which was published in November 2020, the TCFD created an illustrative implementation plan, which is based on the findings of a survey of what report users, mostly investors, found important in disclosure. So in this next section, we're actually going to use that illustrative example as a demonstration of how you can go about improving your reporting. Now, we note that there are different approaches that companies take depending on their capabilities. And when you're setting your own roadmap, you might have a different approach to what we're going to talk about today, and that's fine. Again, I want to reiterate that these are illustrative examples, and they kind of give you a flavor of the type of practice that's out there. I also want to note that these examples are just that we're going to show you from real companies. Some of the company disclosures that we're going to show you were actually published last week. So these might be the first time that they're getting an airing in this kind of forum, but they are extracts. So we have taken them out of context. And in some cases, the companies have provided a lot more detail in the annual report. So we do acknowledge that. Some of these examples are also taken from TCFD reports. Now, we've noticed that there is a trend in Australia and New Zealand to create separate reports, separate TCFD or climate disclosure reports. The TCFD recommend that this information goes into your mainstream annual report, which is very much aligned with what CDSB's mission is, alongside the audited financial information. And this is likely the approach that most regulatory bodies will take. But if you do decide to disclose most of the information in a separate report, we want to make sure that you are properly signposting and cross-referencing the information so that the reader knows where to look. And I've got a few examples in this slide deck to demonstrate how companies are doing that. So to start off with, the TCFD have demonstrated what they think is the foundation for TCFD disclosures. Now, while the TCFD is ultimately a disclosure framework, it is also a framework that highlights the necessary internal processes that need to be adapted to embed climate-related issues within your business. In particular, governance structures and risk management processes can be used to incorporate climate into internal decision-making processes. Now, in the disclosure, we don't expect companies to provide granular point-by-point demonstration of how climate risks are governed, but we expect, at least at the very beginning, an outline and a summary of the board's oversight, management's role, and the processes used to identify, assess, and manage climate-related financial risk. And that's what the TCFD have included in their illustrative example. I think it's really interesting that TCFD has set this as the foundation for good TCFD disclosure, as they acknowledge that this information provides the context in which financial and operating results are achieved. So as a starting point, you should look at the processes in place within your company. And from the survey at the beginning, it looks like these two are actually the elements that people are less concerned with. But we do have a few examples just to demonstrate how you might go about disclosing this. So as a starting point, you want to look at the processes in place within your company. As we mentioned in the previous webinar, find a climate champion, bring together your TCFD team, and in this example, make sure that you are including someone within your risk team, within your risk function. Now, in the disclosures, we also are noticing that there's quite often a separate process being used to identify sustainability or ESG risks, which is not necessarily a bad approach, but we would expect that if you are taking that approach, that you justify why that is and you explain why there are two separate approaches and processes being adopted. And it's at this point, I think I also want to refer back to the previous webinar where we highlighted the different lens that TCFD takes. So we talk about the impacts of the climate, impacts to the climate versus impacts to the business. And in the same way, for risk management, we want to consider the financial risks of climate change on the business. So it's important to consider how climate change is assessed and managed in the same way that financial risks are assessed and managed. Think about how to consider climate as part of your existing risk categories: credit risk, operational risk, strategic risk, and think about how climate can be a risk multiplier and may have an impact across the business. In the same vein, there are some special elements that you need to consider with climate change, and I will whip through some of these quite quickly because there was alongside the status report, the TCFD also published additional guidance, and this extract was taken from their guidance on risk management, integration, and disclosure. It's a really fantastic, to the point guidance. It's quite a short guidance, but it really kind of brings together all the different elements that you need. So while we ultimately want companies to utilize your existing structures and processes, like I said, there are some special considerations that climate change brings to the table. For example, the effects of climate change are going to differ depending on the location. So whether it's local, regional, global scales, And you also need to consider the longer term nature of climate change, which might be different to how your organization and the time horizons used within your organization for strategy setting and risk identification processes. Climate change is also quite uncertain, and there's a cascading nature, which makes it quite complex and unique. And often companies will look at climate change in itself as a risk, but do think about how, as I mentioned before, it is a risk multiplier and can affect other risks, other financial risks. I could keep going on this, and I could have a whole entire section on risk management, but let's move on to some of the examples of how companies are doing this. So the first example is from ANZ, and this is a great example of where they have two disclosures. So they have information summarized in their annual report, but they also have a climate-related financial disclosure report, which has more information. Now, this example is of their governance information. And what we want to point out here is that they have given us very succinct and to the point and clear information that demonstrates how both the board and the executive level roles are involved in oversight and management of climate-related risks. And I think that's a really key point, that your TCFD disclosure doesn't have to be reams and reams and reams of pages. It can be quite succinct. And I think the governance section in particular can be achieved in a short disclosure. The next example is an example of risk management, and it's taken from GPT. This is a report that was published last week. And again, they have two separate reports, a summary in their annual report and a more detailed disclosure in their disclosure statement. This particular example demonstrates how they apply enterprise risk management framework to climate risk. And they also demonstrate the interconnection between the risk management disclosure and the governance disclosure, because they give us information about the role of leadership team and about their cross-functional TCFD reference group and how they're involved in identifying climate risk. So let's move on to the next stage, the next phase, as TCFD put it, and that's on how to enhance your disclosure. And it's at this point that we would expect companies to tell us more about the exact risks that they have identified, how they've affected the business, and the metrics and the targets that they're using to monitor climate-related activities. We talk about risks a lot, but also on the other side, we talk about the opportunities that companies face as well. Meridian Energy, again, have an integrated report and a more detailed climate change disclosure. And these two examples come from both. I am going to zoom in on that table in a second, so don't worry if you can't read it at the moment. But this example, again, really clearly identifies both the risks and opportunities and gives us a huge amount of information in a succinct way through this table. Before I zoom in on that table, I want to note that they, in their summary, reference their CDP submission. So if you are disclosing to CDP, you probably already have a lot of this information already. And just as you would cross-refer between different reports, we encourage you to refer to your CDP disclosure where that information sits, as long as it's publicly available. So zooming in onto this table, and I've purposely picked out their opportunities because we do talk a lot about risk, but let's focus in on opportunities a little bit. They have the same table, but for risks in the report as well. And here they very clearly tell us specific opportunities that are faced by their company. They tell us the type, the scale, the likelihood, which is unusual. This is not something that companies often tell us, but it is really important. The time frame. TCFD recommend that you tell us what the time frame is, but they don't tell you what timeframes to use, because that's going to depend on your individual business, on the assets within your company. But whatever timeframes you do use, tell us what those timeframes are. And then they give us more information about the methodology that they use, what the impacts and the financial implications are. Again, a very succinct disclosure. And again, going further than many disclosures, they also provide quantification of those opportunities. Another example is from BHP. This one focuses on the metrics, and in particular, the Scope 1 and Scope 2 emissions. When disclosing this type of information, and I know that many of you on the call probably already do this, but you'd be surprised about how many companies don't provide year-on-year data. So they only tell us about last year's disclosure or last year's data. By providing more than 3 years of data, allows the reader to be able to analyze what the performance is of the company. To make this even better, you could also put the target next to it so we can see the direction in which the company is moving. In the text, they provide quite a lot of information about how they've calculated this information. So they haven't just put the greenhouse gas emissions in blindly, but they also provide us lots of information about reinstatement, about why their emissions have increased, and some information about their calculation methodologies. Again, all really important information that is sometimes missing in disclosures. Now, the last example, and is the only example that doesn't come from Australia or New Zealand, is from Landsec here in the UK. And we've pulled this one out because it's a slightly different take on metrics and targets. Usually companies provide their scope 1, scope 2, and if appropriate, their scope 3 emissions. But very rarely we see climate-related financial metrics. Now, this is an area that's currently being developed. The TCFD had a consultation out on what financial metrics look like, forward-looking financial metrics look like for the finance sector over the Christmas period. That consultation is closed now, and we'll wait to see what guidance comes out from that. But Landsec have been experimenting with different types of financial metrics. And as you can see here, they look at OPEX, CAPEX, savings as well from investments in low carbon equipment, which is very different to what we've seen before. This is not something that many companies are able to disclose at this stage. Don't worry if this looks like too much to you at this point. Remember, these are incremental steps, and this is kind of a way in which you're building up and improving your disclosure. But ultimately, we do look to see metrics that go beyond just your greenhouse gas data. Now, finally, the last stage that the TCFD talk about is disclosure on resilience. So you could almost call this your scenario analysis section. And this is where we go into a lot more detail about the forward-looking information from the company. We look at scenario analysis and summarize on what does resilience mean, whether your company is resilient to future scenarios. I have one example from here, and I feel like this one is a little bit there is a lot of information in the QBE report, and I've only been able to take a small section because I didn't want to overwhelm you with too many screenshots that you wouldn't be able to read what was on the page. But QBE provide a lot of information about the scenario analysis that they conducted. In the beginning stages, a lot of companies start off by just disclosing their methodology, the approaches that they're taking, and what assumptions behind a 2 degrees and a 4 degrees, for example, scenario is. As your disclosure improves, what we'd like to see is a conclusion drawn from your scenario analysis. Again, as Christin mentioned at the beginning, it doesn't necessarily have to be quantified or quantitative right away. It can be a qualitative summary, but there does need to be some sort of conclusion about whether you think your company is resilient based on the assessment that you've taken. So the example that I've put up on the screen here describes the methodology and the approach that they took to scenario analysis. And this one, I think, is specifically on physical risk. And then they have a lot of information about what they found and what that meant for the business and for their strategy. I was only able to show you a small portion of that, but I do encourage you to take a look at their report and see the level of depth in which they go into. So I've been talking for a very long time, and I hope that those examples give you something to take away and to think about. And just kind of to finish off, we just wanted to give you a few kind of top tips for disclosure, reiterating what we've said in the last 2 webinars. Build on your existing processes, think about how climate differs and the specificities of climate and what you need to kind of change within your processes potentially. Make sure your information is connected, so hopefully it all goes in your mainstream report. But if you're unable to do that, or if you choose to have a separate report, make sure that you are connecting and cross-referencing the information. Make sure your information is clear, concise, and proportional. I think proportional is an important word. Again, you don't need to have pages and pages and pages of disclosure. It's about finding that sweet spot of what pieces of information are particularly important. And if I scroll down, because we've gone over these, so I'm just repeating myself, get to the very bottom, get started. As Christin said at the very beginning, you don't need to have perfect disclosure. It's an iterative process. Get started now, tell us what you already have and what you already know, and build upon that as your disclosure improves.
So that was a great overview of the different phases of the TCFD reporting. And I think the examples really help to understand what TCFD reporting looks like in real life. So I think that's so good. Thank you so much. Now it's your turn. Please let us know your questions. I can see that a few coming in have been coming in already. So are there any specific aspects of the recommendations that we should consider for New Zealand and Australia?
What's ubiquitous in New Zealand in particular, but also in Australia is the coastal vicinity of coastlines. Physical risks are significant. When you look at Australia, I think when you look at the transition risk, for example, the way, thinking about policy change as well, I think Australia has a very rich, very heated but great discussion on climate change, and really interesting work coming out of ASIC and others on climate risks. I think is a transition. The legislative changes and the policy changes are a significant evolution that must be taken into account. In New Zealand, obviously TCFD is becoming mandatory, and the MFE, the Ministry for the Environment, has been really active in pushing out quite significant targets and sets a really ambitious direction of travel for New Zealand, and these are all things that are of course impacting business. These are challenges, but challenges to get to a state where your business is more resilient and more ready for the future. But it's are things to take into account in your reporting, because if these policy changes are coming your way, it's a given that your investors will be interested in how you're dealing with them and how you're positioning your organization in the future. So I think in particular, looking at the transition elements of risks and opportunities. I'm very glad that Gemma, you chose the opportunities to showcase, which are not getting enough limelight. These are things that your investors will want to know about. So very much a key issue, I think, in the region.
Thanks, Mike. Great answer. Yeah, I think the transition risk is really where the difference really is important. So we have a question. It's actually two parts, and I think one of the part of the question can be answered by one of you really clearly. So what existing or soon to be released scenario models would you recommend mid-sized companies? And I think we had another one like around how can I get started with scenario analysis?
In terms of the existing models that you can use then to reference, I think the most common ones being used for transition and physical risk are the IPCC models, and that's for the physical risk element. And then the transition risk, especially around energy, the World Energy Outlook model is probably one of the best. They have a couple of scenarios based on different outcomes that you can reference. And if you go onto the TCFD Knowledge Hub, there's a specific page on scenario analysis. And on that page, there are some kind of top tips about how to get started, some of the considerations that you need to take. And there's some resources at the bottom there that might be helpful. Actually, last week as well, and I'm not sure how relevant it may be, but the UNEP-FI released a paper looking at the climate risk landscape and all the different methodologies that are being used. Most of them are focused on the finance sector. So I don't know how helpful that will be to some of you. I think it's interesting to know what different approaches are out there, and to understand which ones are best for you. But also take a look at a recently published, so the TCFD published 3 documents at the end of last year: their status report, the risk management guidance that I spoke about, and then a scenario analysis guidance for non-financial companies. That's a big piece of work. I think it's a couple of 100 pages, but really, really detailed. So do take a look at that, and that's what I would suggest.
Perfect, thank you. And we will have all these resources on our resource landing page. So everything that we just mentioned in terms of resources and useful documents are summarized on that page. So I think we have time for a couple more questions. So one came in: have you seen a significant uptake of organizations including a TCFD content index in their reports? So at the end of, alongside the GRI content indices, for example, which map out how they have addressed TCFD recommendations?
Yes, we have seen. And actually it's a great way. So I talked about cross-referencing in my presentation. That's a great way to do that, and especially if you've got information that's dotted around your mainstream report, or if it's in other reports. So we have seen examples. I think Westpac do it quite well in Australia, but I also think that another good example is Total, and they have a summary table that then demonstrates not just which pages to go to, but also which reports and which CDP disclosure questions the information refers to. So that's definitely a great approach to take, and you'll find that information if you do a gap analysis. Again, at the beginning, Christin talked about the importance of doing a gap analysis when you first start, because you probably already have some of this information. So that gap analysis will help you to know where exactly all that information is.
Perfect, thank you, Gemma. Really well answered. I think that's really good to see. That is also just already happening, and really well structured. You don't need to create something new artificially. So maybe the last question, and I think it was partly covered as well. So who should a New Zealand business turn to if it needs support to get TCFD-like reporting started? Is it the accountant?
And a really excellent question. I think, you touched on it as well. It really is a multidisciplinary effort, but the accountant needs to be in the room. They have a lot of experience on the rigor, and also the links to the financial performance, which I think are crucial. But it really isn't something that one function can solve by itself. So it's the finance team, definitely, whoever's working on the annual report there, looking at your risk management colleagues, investor relations, crucial, of course. Sustainability, I guess, is a given, a crucial player, coordinator there as well. Anyone else I forgot, Gemma? I think these are the key that need to be in a room. But I think there's a lot we can learn from accounting, and especially in the case of Australia, where the Australian Accounting Standards Board and the Australian Audit Standards Board has issued guidance on the interpretation of the materiality of climate change on the Australian financial standards. So the Australian financial reporting standards, the financial reporting standards, and how they're implemented by climate change. This is also something that doesn't necessarily stop at the narrative and sort of the first half of the report, but can also have an impact on the second half of the report. That's perhaps a more advanced discussion for another time, but always happy to talk about that as well.
Perfect. Thanks, Mike. And of course, you can also reach out to us if you have any questions. I think with that, we will have to wrap up. We ran a bit over time already, and we will make sure to get back to you if you have any further questions. So just please get in touch. Yeah, so as mentioned, all the useful resources that were mentioned today, but also in the previous webinars, are summarized here. So many CDSB resources, but also from the TCFD themselves. Check that out. It's really useful. And yeah, Huge thank you to Gemma and Michael for taking the time and sharing your insights with us in this webinar series. You truly deserve to finish your day now. And thank you to all of you for joining us today. If you have any specific topics that you would like us to cover or any general feedback, please do let us know and get in touch. And we are looking forward to seeing you next time. Have a good day and a good night. Bye.